Hello and welcome back. My name is Benny Victory, reverse mortgage specialist with over 20 years of direct mortgage experience. Today's video is going to be really fundamental. It's going to be essential for you to understand this concept because one of the biggest objections that I hear over and over again around a reverse mortgage is the idea that by getting a reverse mortgage, people are losing their equity. So, in order to understand what equity is, I have a little bit of a prop set up today, so I'm really excited. We got visual aids. But I feel like if you understand this concept and what equity is, then you will understand that a reverse mortgage doesn't work against you. It actually can help in favor of keeping your equity. So, here we go. Fundamentally, a reverse mortgage allows the home borrower, homeowner, to be able to access a portion of their equity. And by accessing the portion of their equity, not have to make a mortgage payment for the rest of their life as long as they live in the house. So that not making a home payment conceptually increases the balance of the mortgage. But equity is not independent of two other aspects of what is taking place. What's taking place? When you get a mortgage and you're making your typical monthly payments, every month that balance is coming down minimally, minutely, by several $100s, and at the same time, the bulk of your payment is an interest payment. So if you were to look at an amortization schedule, if you take your existing mortgage balance and you looked at your monthly statement and you saw how much you're paying, it typically has a breakdown of how much is principal reduction from your principal balance and how much is interest payment. That's the typical way people gain equity in their home. The other way people gain equity in their home is through home value appreciation. Home value appreciation is the concept that you bought your house for $200,000 and 6 years later the property's increased, and now if you were to sell your home, you could sell it for $500,000. That's an easy concept to understand because you understand that your home was $200,000 and now it's $500,000. So you look at that $300,000 increase as equity appreciation. But you didn't get this equity appreciation by reducing your balance. Yes, you continue to make mortgage payments for the last 3 years, and if you look at your mortgage statement, your principal outstanding balance may have gone down $10,000, $15,000 depending on the type of payment you're paying. But really the appreciation that you gained was through home values increasing. Now the opposite of that is also true. The opposite of it is home value depreciation. This is what happened in 2008, 2009, all the way to 2013 and 14. And people who stayed in their homes saw a significant reduction in home appreciation. And that was something that they had no control over. In other words, you don't have any control over whether your house values increase or decrease. All you could do is ride out the market so that if it's in a reduced depreciating market, you stay in the home, you continue making payments until the property values start to come up again. And that's where we are right now. January of 2022, home values have again skyrocketed. So, what does that have to do with our SAFE and our visual aid and a reverse mortgage? A reverse mortgage, because it allows a portion of the equity to be set aside for you, allows you to, in essence, take a snapshot, freeze the market appreciation that you're experiencing today, so that when property values go down in the cyclical market, you don't lose that value. So right now, for example, I'm doing a loan for a client of ours. He's 72 years old, property appreciated, we appraised the property. Property is appraised at $725,000. There was no mortgage on the property, so he's getting a line of credit for $359,000. And that $359,000 is going to be set aside for him because he doesn't need all of that money right now. He only needs a portion of that money every month to take it out so that he could age in place and stay at home. So what's happening? His house appreciated and now is worth $725,000. But he doesn't want to sell it and go somewhere else. He wants to stay in the house and age in place. But he also wants to take some of the equity that's in that house and set it aside so that he can pay for his everyday cares and monthly expenses and his nursing needs. The line of credit will be set aside for him, and if the property values go down from $725,000 to $500,000, 2 years from now, 3 years from now, the bank is not going to come and say, remember that line of credit that we gave you for $359,000? At that point, your property was worth $725,000. But now your property has gone down to $500,000. So we need to reduce your line of credit. We need to close your line of credit. We need to freeze your line of credit. An aspect of a reverse mortgage that is so incredibly beneficial to the senior is that the line of credit on a reverse mortgage can't be touched by the bank, regardless of what happens to property values going down. That's part of the insurance that you get with a reverse mortgage, which is the mortgage insurance protection premium. Okay, it's an insurance policy, and it protects the bank, it protects the government, it protects the borrower, because it's insurance that you pay as part of getting a reverse mortgage. That's one of those high ticket items that people freak out when they see a reverse mortgage and they're like, oh my God, it's $20,000. Yes, it's $20,000, but it's protecting you for the rest of your life against what happens if the property value goes down. So, going back to this concept of equity, you don't build equity because you're not able to pay down your principal in a significant fashion, large enough every month so that your mortgage principal balance goes down significantly. You build equity by staying in the property and having the property over time, over these cyclical market trends, to continue to go up. Okay, so this is your home, and it's actually, I think, a very good representation because this is all what a home is. It's a safe place for you to live in, and it protects your assets. And that's what this little safe represents. So when you want to get a reverse mortgage, we look at your age, we look at the interest rate, and we look at the property value appraisal, and we put it together and we come up with a number that is going to be your loan amount. Obviously, the older you are, the more access to equity that you have. But again, if you understand that equity is cyclical, what happens is if you're 72 now and your property appraises for $725,000 and you say, well, okay, I don't need the money right now, I'm not going to get it, what's going to happen? When you turn 74 and you come and say, let's get a reverse mortgage, there may be a chance now that property values are no longer $725,000. Now the properties are $525,000. So even though now you're technically older 2 years, your property values have gone down by as much as $200,000. So you're going to get significantly less money. Now, how do you protect yourself against that? Well, you protect yourself by looking at where the market is right now. We realize that we're in an upward trend. And you say to yourself, I don't need the money right now. Well, you don't have to need the money. You have to be able to take advantage of the opportunity. So how do you do that? Well, you get the reverse mortgage in place You get the line of credit made available to you. You appraise the house. So now when you appraise the house and your property value is high and the loan is done and completed, you don't have to worry about what's going to happen to property values a year from now, 2 years from now, 10 years from now. You have made this money and made it available for you in a separate bucket, which is your line of credit. That line of credit is designed for you. It's there on the side. You don't have to access it. It's like saying, I have a credit card with a $10,000 limit, but I don't have the need to buy anything, so that $10,000 is going to be made available for me when I need it. That's a smart use of equity through home appreciation. Now, if you do that and you get the reverse mortgage in place, you've protected yourself in the future against property depreciation. Because what's going to happen? When the property values go down and your age goes up, we don't know where the interest rates are. And that's one of the factors in determining how much money you're going to get. We don't know how long it's going to take for this property value to start climbing up again. And again, if you think about 2008 to 2014, it took about 10 years for property values to start leveling up and leveling out again to where we are right now. So at that point, you may have been 50 years old working and making money, and it didn't matter that the property value depreciated by 30%. Now you're 65, 70, 75 years old. The question becomes, at 75 years old, can you ride out another real estate downturn in a cyclical real estate market that could take 10 years for the property values to come back? Do you want to, at 75, risk losing the equity that you have in the property so that you can't access more money when you need it and have it available for you on the side? That's the biggest concept and misunderstanding around equity, because people think that simply having a reverse mortgage means that you're going to lose equity. It really depends on what type of a mortgage you're starting with. If, like my client, you're 72 years old, your property is paid free and clear, we appraise it for $725, you're now getting a $359,000 line of credit that doesn't have to start unless you draw that money. Now, let's say you have the same situation, but you have a $200,000 balance. You're 72 years old, and we appraise your property for $725,000. Well, the reverse mortgage is going to pay off your existing balance at $200,000. You still now have another $159,000 available to you in your line of credit. So you could now approach it in two different options. You could say to yourself, I have this $159,000 line of credit, and I'm going to let that sit there, and I'm not going to use it until I need it. But I also paid off my $200,000 existing mortgage on my house through the reverse mortgage. Do I want to use my option of not making mortgage payments every month and let the balance increase year over year? Or do I want to use some of my income that I'm getting every month to pay some of the mortgage balance that I have? People think it's a binary, optional choice that they have to make. They have to make a payment or they don't have to make a payment. The choice is up to you whether you want to make a payment or not make a payment with a reverse mortgage. If you choose to make a reverse mortgage, it'll go towards your principal, it'll go towards your interest, and you don't have to accrue a negative amortized interest. If you choose not to, because you understand that your balance of $200,000 on a house that was appraised at $725,000, there's a significant amount of equity appreciation that you have, and it doesn't matter if you reduce your principal by $10,000. The conversation I have with my clients is like, you're 80 years old, you're 85 years old, you owe $200,000, the house is worth $725,000, $750,000. What does it matter to your lifestyle if this mortgage is reduced from $200,000 to $180,000? It makes absolutely no difference. What matters to you is to be able to age in place, have the guarantee that you could stay in the house for the rest of your life, and that you never have to worry about making another mortgage payment, so that you could use the money that you were paying for a mortgage to pay for something else, to pay for your property taxes, to pay for your homeowner's insurance, to pay for your medical care needs. That's the concept that I want you to grasp, because if you keep focusing on this concept that a negative amortizing concept on a reverse mortgage is going to make you lose your home, you really don't understand what appreciation of equity is, what depreciation of equity is, what it's dependent on, and how you can use a reverse mortgage to help you. In the other video that I made reference to several books that are fundamental and help you understand what retirement is, how to plan for retirement, what a strategic use of a reverse mortgage is. And a strategic use of a reverse mortgage is the concept of using a portion of your equity while you have this home appreciation to your advantage. If you lose the opportunity, you lose the market cycle when it's up, then you're going to be in a situation where 2-3 years from now, yes, you're older by a few years, but your age is not going to make up for the significant amount of depreciation that you lose. So, where does this lead us? It leads us to having a conversation in your particular situation right now, assessing what your monthly income needs are. How much are your expenses? How much money do you get every month? What is your home value right now? And if you've been there 10-15 years, you remember when the market was down and how much equity you lost through depreciation in market values. Taking these numbers and coming up with some solutions for you. If you have an existing mortgage, what would that look like if we paid it off for you and you don't have a mortgage payment that's required? It's optional. What does that mean if your house is paid off and you have it owned free and clear, but it's not accessible? If I tell you I have $1 million in here, but I don't have the combination to reach in and access the money, then it doesn't matter what's inside of here. Your home is that concept. Your home is that concept of your house is appreciated, but you can't access the money unless you have a mortgage against it. Well, when you're 80 years old and you're on a fixed income, when you're 70 years old and on a fixed income, the bank is not going to lend you money because you have a limited income. You have a lot of equity, but if they give you $300,000 and you start taking that $300,000 and you're making $2,000 from Social Security, how are you going to be able to use that $2,000 to pay for all of your expenses and to pay the loan? Well, you say, well, Benny, I'm going to use the money from the line of credit or the money from the bank that they gave me. Yes, but when you start taking that $20,000, $30,000 draw on your HELOC or on your mortgage, that's going to produce a payment at the end of the month. And that's what the bank is counting on to get its money back. So it becomes the snake eating its own tail. I'll give you $200,000, you take $50,000 out, now you have an $800 payment, but your income hasn't increased. You're still making $2,000 from Social Security. So how are you going to pay the bank back? So you're not going to be able to qualify for a traditional mortgage. A reverse mortgage will allow you to access the equity in the house. So I love this. This is the whole reason I got this. So here's a visual representation. This is the home. There's equity in it. I'm going to reach in. I'm going to open the safe. This is all the equity that I have. I'm going to take some of that equity out. Okay. Here's a portion of the equity that I need. I'm going to take the balance of the equity and I'm going to keep it in the house. I'm going to still age in place in my own house. But guess what? Now I have my equity, a portion of my equity. And through this portion of equity, I'm going to be able to live comfortably, being financially independent, not having to go to my children at the end of the month and say, I'm short, can you help me? Not having to worry about not getting the proper care that I need because I don't have enough money. Not looking at my home and saying, I'm broke, I can't have what I want, but I've got $1 million worth of equity in the house, but I can't access it. I hope you really go back and watch this video again, because if you visualize the concept, if you understand what we just talked about, then you really understand a reverse mortgage is not your enemy. It's not the problem. It's a big part of the solution. That's why if you listen to Dr. Wade Pfau and look at the statistics of people that make it through retirement and survive and don't outlive their money, a big portion of that has to do with having access to a limited portion of the equity that they have. So please consider the concepts that I talked about. Get your information from educated, licensed individuals, not kids that are on YouTube in their mother's basement talking about how bad a reverse mortgage is. And if you have any questions, if there's some concepts that you need to go over and get more clarity on, reach out to me and I'll be more than happy to talk to you. I appreciate your time. I know this was a little bit longer than video than necessary, but I'm concerned about the concepts and the amount of information that you need to have to make an educated decision. And if that's been satisfied, that's all that matters to me. Thank you very much. I look forward to seeing you in the next video. God bless and take care.